Okay, now that we have made our way through that first question, let's take a look at the next set of questions, all related back to a simple start where a company forms with $32,000 in common stock. They receive cash revenue of $55,600, and then we have this $36,600 that they pay for some sort of cash payments. So in the first application of the same data set is a rock concert promoter. So the idea here is that the $36,600 is for operating expenses. We have the $55,000 in cash revenue, and this sale of those common shares of stock. So what we're put up against is putting together the income statement. So again, whenever we put together an income statement, we're going to start with our revenue. So our revenue was $55,600. Our operating expenses were the $36,600, and then our net income is simply our revenue minus our operating expenses. So we should have a net income of $19,000. Okay, so then when it comes to putting together the balance sheet, we can take a few different approaches to this. Again, no right or wrong way to go about it necessarily. The approach that I would take is I'd come back to cash because I know that there's no liabilities. I know that the common stock is the shares that we sold this year, the 32,000. Because this is a first-year company, I know that the retained earnings it started the year with was nothing. They generated $19,000 in net income. So the retained earnings that it's going to end with is also $19,000, the same as the net income. So then the total liabilities and stockholders' equity is the sum of those three parts, or $51,000. I know that they have no other assets, so cash then has to be $51,000. The other way we could go about this is cash. The other way we could compute that off to the side here, just to make sure we get the same number, is that we started with no cash. Cash went up when we sold our common stock. Cash went up again when we had our cash revenue. Cash went down when we paid for those operating expenses, $51,000. I kind of like the shortcut approach. It's a little more direct and easy. Kind of back into that cash balance. Okay. So moving on to the second scenario. Again, we're starting from the same point where we had common stock, $32,000 that we received from the sale of that common stock. Our cash revenue is still $55,000. But in this scenario, we have a car rental business. That's our business that we're considering here. So these cash payments were actually for the purchase of the vehicles that we will be renting out to our customers. So, sorry about that. Okay, so so we need to look at the depreciation of those vehicles that we purchased for sale. So we need to look at the salvage value and their useful life. Both of those are elements that we're going to need in order to calculate out the depreciation of these assets. So the salvage value of these vehicles in my scenario is 0. They're expected to be worthless when we're done with them. The useful life for these, 3 years is what the assignment tells me. So again, I'll take the cost of those items, those vehicles, subtract its salvage value, and divide that cost that's left over its useful life. So 1 year's depreciation will be equal to $12,200. Okay. So again, we're looking at it's the total cost, subtracting its salvage value, and dividing it out over its useful life, the cost that remains. So when we go put together our income statement, here again our revenue is our cash revenue, the money that we received by renting out those vehicles that we purchased. Our only operating expense is our depreciation. So in this scenario, it's the $12,200. And then we can calculate our net income by taking our revenue and subtracting our operating expenses. So we should come to a net income of $43,400 for this particular scenario. We then need to calculate out the balances on our balance sheet. Again, cash, we can look at that 2 different ways. We can look at we can come back to it at the end, or we can just look at the pluses and minuses. So cash we started off the year with nothing. It's going to go up when we get the money from selling the common shares. It's going to go up when we receive that revenue from our customers. It's going to go down when we make the cash payments for those vehicles. Our rental equipment that we purchased, the cost, our historical cost of that was that $36,600. The accumulated depreciation after 1 year is this $12,200. That's all we've accumulated after the asset's first year of operations. So our total assets at this point are going to be our cash, our rental equipment, minus our depreciation that we've accumulated. Our total assets are $75,400. We still don't have any liabilities. And then again, within our equity, our common stock is going to be equal to what we sold in shares. And our retained earnings began the year with nothing. We generated a net income and did not pay any dividends, so our ending retained earnings is equal to our net income for that given year. And hopefully our liabilities plus the 2 elements of our equity is $75,400, which happens to agree to our total assets. So we are good to go on question number 3. Next up, we have our manufacturing company. So a few different facts and circumstances related to that. So this one's going to be obviously the most complex in our calculations. But again, we still have that $32,000 in common stock that we sold. We still have our cash revenue of $55,600, but now our cash payments of $36,600 is chopped up a few different ways. We have our direct materials that we purchased, our factory worker wages, our administrative wages, as well as the purchase of our manufacturing equipment. So again, we're going to need to look at our depreciation expense for our equipment. The only equipment we have is this manufacturing equipment, but let's take a look at how that comes together. So again, the salvage value as well as its useful life. Let's let's see here. In my example, it's telling me that we paid $20,500 cash to purchase manufacturing equipment. The equipment was used solely to make products. It has a 4-year life and a $2,100 salvage value. So its 1-year depreciation is going to be its total cost minus its salvage value divided by its useful life. So 1-year depreciation on that that manufacturing equipment is going to be $4,600. So now let's take a look, just like we did in question 1, let's take a look at dividing these into product costs and period costs, so we can be able to figure out which category each of these are going to go into. Common stock, that's money coming in. Revenue, that's money coming in. So our materials purchased, that's going to be a product cost. Our factory workers, direct labor, that's also a product cost. Our administrative wages, that's a period cost. Our selling and administrative expenses. And our manufacturing equipment, that's going to be our overhead for our product costs. So our grand total here, we have, let's see here, we have $9,890 in product costs, and we have $10,800 in period costs. So the problem also told us that we had 2,300 units that we started and completed. So that's what we manufactured for this period. We also sold 2,000 units. So the items that we started and completed, we have a product cost of $98.90. We can divide that out over our 2,300, and that will give us our costs per unit. We know that we sold 2,000 units, so if we multiply 2,000 by $4.30, that's going to give us our cost of goods sold. We're also going to need to figure out how much our ending inventory is worth. So there we're also going to need to determine how many we have units on hand. And again, we're going to just simply look at how many units we started and completed. Again, because we're a first-year company, we don't have beginning inventory, ending inventory, which can add some more dynamics to these calculations. So we just subtract off the units that we sold. That tells us we still have 300 units on hand. We can multiply 300 by $4.30, and this is our finished goods inventory. Okay, so again, we're going to put together our income statement. Our revenue is still the same. Our revenue is $55,600, but now we have our cost of goods sold that we calculated up here of $8,600 that's going to come into play. So there, our gross margin is going to be our revenue minus our cost of goods sold. Our administrative expenses are going to be our period costs that we identified over here on the right. And then our net income is going to be our gross margin, our gross profit, minus our administrative and selling period costs. So our net income for this question is going to be $36,190. All right. Video 3 will continue with the tail end of question number 4 here. We'll put together our balance sheet and as well as get into some additional questions. The second word for the string for the email is. The second word is.